Welcome back to our 2025 Outlook, joined as always by Aaron Tuttle, and hopefully as always by Jeremy Schwartz. It's been his third year coming back on for our first of the year Outlook. He is the Global Chief Investment Officer at WisdomTree, overseeing $110 billion, and he's the co-author of Stocks for the Long Run. He was very bullish in 2023, correctly, and let's take a look at all of our picks for 2024.
If you hadn't hit that subscribe button, hit it now. We got John Miller, who's a bond king, or he doesn't like that phrase, but we like it. He's been a portfolio manager for quite some time, but he's actually showing up as an emerging bond manager in our search. So don't miss it. Hit that subscribe button. Make sure you hit that like and share it with your friends so they also don't miss it.
All three of us were bullish on the economy and equities, which was the right call. Then we moved to asset class, sectors, or geography. I stuck with large cap, which remained a good call as well. Aaron went with gold and small cap. Pretty good call on gold. Gold had significant outperformance, and small cap had a good year, just not relative to the rest of the market. And Jeremy went with a flyer. He took biotech. Jeremy, what the heck's going on with biotech?
Well, also, whenever you pick a sector, a lot of things can go for you, against you. We thought it was one of the losers for a few years in a row, and that gave up some compelling valuations. I actually am sticking with it for this year. I actually just doubled down on my purchases at the end of last year, bought some more biotech. When I think about the key trend, you hear AI narrative is like the number one theme. NVIDIA is like the prime beneficiary. All the money, people are saying we've got this existential moment. We got to buy these data centers. We got to buy NVIDIA chips. All the big companies are investing in them. And you understand sort of the race for AI is a key topic. And I say, well, who's going to benefit the most from all this technology? I actually think people who have research heavy processes, and I think biotech is the core of that thesis. Now, you've got all sorts of different things. You got the politics angle. Elections tend to be tricky for biotech. You have a lot of unprofitable companies. Higher for longer hurts biotech. Then you have some of the comments from RFK, sort of skeptical on some of the vaccines, or that people interpret him as being very skeptical. And I think reality, though, is when you think about the new administration and you have the DOGE, the Department of Government Efficiency, you have Vivek Ramaswamy part of it. He came from biotech. He was somebody who talks, you think about the time it takes to get a new drug approved. What if you have this force of new technology driven by AI and actually trying to speed up the process to get things approved? I remain bullish. It was wrong last year. I'm sticking to my guns. I like it again.
I love it. You just sharpen your pencils, redo the facts, and try to figure out. And if your thesis is still right, you just put more in. That makes sense to me.
And you're just early. Maybe you're not wrong.
Right.
And before we get into 2025, just wanted to close out the fixed income, where you guys both had green check marks for predicting interest rate volatility and interest rates trending higher. I thought we'd see I was only one of us bullish on interest rates, thought we'd see them come down a little bit. Still had a great year in bonds relative to our benchmarks there. But let's get into 2025, Jeremy. How are you approaching the economy?
Well, it's, you've got this key force. The Fed is on pause to start the year. They, at the middle of last year, our economist, senior economist, my mentor, Professor Siegel, was calling for aggressive rate cuts. He thought they were too high and needed to bring things down. And partly the comment was they wanted to uninvert the yield curve, that they had the short rate much higher than the long rate. He had got at some point the 10-year down to 3.6, and the Fed was in the fives. I mean, it was a dramatically inverted yield curve, which we thought was a problem. And our view is that inflation is trending. Well, we still think inflation, when you put in some of the real-time data on housing in particular, is trending in the right direction. Now, if I start this year, the 10 years already been creeping higher. The Fed cut 100 basis points. The 10 years moved up more than 100 basis points. We actually still think there's more to go on that. So as we're recording around 475, a little bit higher, we think it could get up to 5 to 5.5. Now, what will get you to the top end of that range is the Fed doesn't cut. They have usually the Fed funds to the 10 years around 120 basis points, 125 basis points in a normal environment. That gets you to 5.5 based on where the Fed funds is today. And so now what would get you there? We've got continued robust jobs growth, productivity is going up. We talked about technology and the key beneficiaries. We do think there's still going to be more productivity that comes from all this technology. And so a healthy economy could get you to that 5 to 5.25 or even higher rate. And so, we're still careful of adding to duration at the moment.
First question, and you already went to the Fed. I've asked you this 3 years in a row now. When can we finally stop talking about them? I was hoping it would be last year, but it doesn't look like we're going to get that yet.
I mean, I actually somewhat think we're getting there, in the sense of that the Fed's becoming yesterday's story. It's now a lot of the geopolitics, a lot of the new administration policies. So I actually think the narrative is now turning to what is Trump going to do versus what is the Fed going to do. The Fed is actually somewhat becoming boring. Now you could say this higher for longer keeps them as part of the conversation. You've got people are trying to interpret Chris Waller's out on the tapes recently, and they're saying, he's actually talking about a lot of the inflation still being these imputed variables, which is what we talk about for the rental variable. The owner's equivalent rent is one of we think, the key drivers of inflation. And so he's saying, hey, we could still cut because most of inflation are these imputed variables. Is he auditioning to be the next Powell and trying to get in Trump's good graces, or is that his worldview? We agree with it that the actual inflation is much lower, but it'll be interesting to see how long they stay paused. What does the official inflation data show? How does that afford them to cut? But it is now about what are the new policies going to be of the administration more so than the Fed.
So we're shifting from monetary policy to politics.
It's the same thing, right?
So what is that? So the last few years you've talked about price to earnings ratios. You've always said 20 was a good target on fair value on the market. We're a little above that now. Has that view changed?
Well, that's the risk. If there's a risk in the market today, we're right around 23 times earnings. And with, you think the last few years you've had very good earnings growth, almost double digit, not quite double digit, 8-9% earnings growth the last 2 years. The analysts are forecasting 16-17% for this year. And, you're at 23 times. So 20 is fair. There's no question 20 is fair. Now, the 10-year tips, a lot of people have said we've gone inverted on the earnings yield versus the bond yield. And on the nominal bond yield, yes, it's true, actually. Now, 480, the earnings yield in the S&P is closer to 430. It's inverted. You got a negative versus bond. Now, that's not the right way to look at it. We are adamant. Stocks are real assets. Earnings grow with inflation over time. Dividend growth goes with inflation over time. Last 70 years, dividend growth has been 2% above inflation. And so you can't look at the nominal yields, even though the bears will point out this, bond yields are higher than the earnings yield. But the 10-year tips is basically the highest it's been, getting close to the highest it's been in a decade. It's 230 approximately. So you've got a 2% equity premium. That's not as rich as it's been historically. In our long-term data from stocks for long run, you got 3.5% of stocks versus bonds. You're closer to 2 today. Now, what could justify more than the 20 PE is if earnings growth from these tech companies continue to outperform everything else forever. I mean, that's the risk, is that if they mean revert on earnings, that 20 is what's fair. Now, can they grow above? They've been growing above average for a very long time, and they keep doing it. So the question is, when does their earnings growth stall out? But we do think 20 is generally fair, and this year, the 16 to 17% earnings growth is one of the risks for the market.
Where does that view get you on portfolio construction in terms of asset classes?
We came into the year, and again, we think the 10-year is going to creep higher. We think that's going to pressure the markets a little bit in the short run. We're still constructive. I mean, stocks for long run is our mantra that works 75-80% of the time. And I still think we would say stocks versus bonds is where you want to be. Partly because we still think bond yields are creeping higher for the full year. And so that does have us wanting to be in stocks. But in the short run, there's pressure from those rates creeping higher.
A little bit of caution, sounds like. And what's tough, and you've written about it, is when you're looking at annual returns, they usually tend to be really large, small, or negative. You rarely get that middle average return in the 7 to 9%. So have you put a percent on it of kind of what you're expecting with this caution?
Well, we've had 2 20-plus years, 2 monster years. We put a range of like 0 to 10, so still thinking a positive number, but not the continued above average. Can you get another blowout year? It's possible. That would get, if you had the blowout year because of excitement for this technology and what's happening in AI, that's certainly fueling those tech stocks. Can that continue and just surpass everybody's wildest imaginations? It's possible. And then you get to these, we haven't called today's AI trade a tech bubble at all. So we say, yes, they're expensive, but they're justifiably expensive because their earnings are growing so much faster. If you get, this further wave of enthusiasm that spikes you even higher on, say, the NASDAQ and all these others, now you're approaching like the 97, 98, 99 type moments potentially. So it's possible, and that would get you more and more cautious. But our range is more like 0 to 10 for this year.
Well, that makes sense. I wanted to close out the asset allocation with talking a little bit about foreign equities and the dollar. Dollar's been really strong, and one thing that always kind of gets me a little bit is when you turn on TV and the talking heads, dollar's up. They like to talk about how that's weak for 40% of the foreign revenue in the U.S. stocks. Yeah. But then if the dollar's weak, they'll talk about how that's weak for U.S. stocks too. And generally, if you're going to have international outperformance, the weak dollar does help. So how are you approaching that?
No, it's interesting. International stocks, I was just pulling up a chart before we came on. Last 3 years, basically have done zero. If you did a broad international index, practically zero. Now, there's a lot of winners and losers in that, with the broad international being zero. You have big loser China. China's down like 30% when you look at some of the broad ETFs. You've got some winners. Japan, India are sort of two leaders we like. So where international matters, the dollar, as we've talked about many times before, I think most people get this dollar question very wrong. The dollar, now it's interesting, the earnings from abroad, I agree with that thesis that a strong dollar does put a little bit of a headwind to earnings. And some of my research shows the best earnings growth was during weak dollar periods. Now, again, the market's been driven so much by tech companies. They've been a little bit immune to just the so strong dollar. Their earnings have continued to be so strong. But in general, the dollar acts as a headwind. When you have a weak currency overseas, it does act as a tailwind. So a lower euro helps make the European companies more competitive. We got a 157 on the yen compared to where you were on Japan 3 or 4 years ago, 120s or below. They're making a lot more yen revenue. So that's been very supportive for earnings growth in Japan. I don't think Japan's gotten more expensive as it's led the market higher internationally. So I still think the dollar, people don't have enough strong dollar exposure in their portfolio. Now, you've got tariffs. This is like the big open question on policy. What are these tariffs, or how much rhetoric, how much is real? Is China going to devalue their currency? What if they do? What other currencies are going to have implications? I still wouldn't be bullish the euro. I mean, we're trending down to 102. Not so long ago, it was at 112, so it's moved 10 points. I've seen a number of calls to go well below parity. Again, that is still very uncompetitive. Now, can you have a resolution in Russia, Ukraine that brings some more capital back to Europe? That's, the upside case for the euro. But there's volatility. All this stuff leads to volatility. Why do you want to bet on these currencies, buy cheap stocks overseas, forget about the currency? That's one of my core theses. And that, adding more strong dollar exposure portfolios acts as a hedge. You see it if my view on the 10-year that it's going to 525 is right, the dollar's going to get a lot stronger. And I think that also is one of the places that could do well when bonds aren't doing well. That also acts as a hedge against stocks in some ways. So it's always a useful diversifier.
You were one of the first companies to get that Bitcoin ETF application in. I know they ended up giving you guys all approval at the same time. Are you seeing anything change in terms of adoption when it comes to digital assets?
Certainly, this has been a topic with the new administration. You had it was very tough. I mean, usually we think of the U.S. as the financial innovator. Europe was ahead of the U.S. by like 4 to 5 years on allowing these types of products. We got to see what does got a new SEC chair coming in. We'll see. We only really have Bitcoin and ETH, two crypto assets as ETFs today. What will be the regulatory environment for them? As there's a lot more of that happening in Europe today. I do think it'll get more competitive. The more use cases, the more interest it brings. I think Bitcoin was driven by that sentiment, and you got a huge amount of flows go towards the ETFs. It opened it up for new investors, not in a way people in the crypto community could buy it themselves, but bring it into the more mainstream Schwab account, your Fidelity account, you could buy it as an ETF. It helped onboard another set of investors. let's see, you're going to have to actually prove use cases across the rest of the community and be more than just sort of this one early year of the new ETF flows. But we like the technology. We're using it ourselves. We think there's benefits, and we do think the plumbing is better for building financial companies at top of it. I mean, we're building wallets to try to enable this to compete with banks in many different ways. I'm excited by the technology. And then you get the speculative nature of the cryptocurrencies themselves, crypto assets, and the tokens. And I think it'll be, the next 4 years, you're going to have a lot of technology, a lot of new developments there that brings the use cases to more people.
All right, Aaron, let's close it out. As always on these forecast calls, you pick an asset class, sector, something you think is going to have a strong year. Why don't you kick us off, Aaron?
I think the FAMA French model is going to start to reassert itself. I do think growth will continue to do well in that, in the large cap, because of their scale. I think that's the reason they've been able to offset a lot of this. So I think they'll be at about a market rate, but I will go down and take small cap again. I think inflation will continue to trend. I do think rates are going up, so I'm not going to make the gold call there. But I think those higher rates kind of reinforce that FAMA French as people move to a value and a lot of earnings growth versus just financial engineering where they're trying to play some arbitrage game.
I think it's a reasonable pick. For me, I'm going to take similar approach, but go in the private markets. I think you're going to have this tailwind of M&A, IPOs. I think it's going to allow them to mark up those portfolios a little bit, get some good activity, and I think we'll see outperformance in private markets. Jeremy, close us out.
Well, private markets, interesting. You need it's sort of like small caps in some ways. They're both the only, who's paying the higher rates from the Fed. They're only, if you're private, you got these floating rate loans, and the small caps are paying the floating rate. So they're kind of in some ways derivatives of the same trade. Not to be overly agreeing with everybody here, I think, one of the things I like is this broader participation in the rally. I particularly like companies that are doing a lot of buybacks today. You could get a basket of companies with 13, 14 PEs doing 5% buybacks. So you get a 7% type total shareholder yield, 2% dividends, 5% buybacks. When the S&P is at 23 times and you get a 4.3% earnings yield, if you get 7 on dividends and buybacks, I think that's attractive. So that's a place to be where you've got compelling current valuation, sets you up well, and for this broader participation story. So we're agreeing in many ways, maybe just with some different executions on how to get there.
Well, now I'm worried.
Well, Jeremy, thanks for joining us, and we'll see everyone next week with John Miller for our Municipal Bond Outlook.